Ken Rogoff is out within the social media space today talking about negative interest rates is a new recession tool. This is not a new idea, but he underscores again, the next time we see a slowdown, we've got a new tool to use. Do you agree that negative rates can be a proactive or prescriptive tool in a time of economic slowdown?
Well, I think moving towards negative rates was perhaps an important step for central banks. I mean, the ECB did that in 2014. We're now at minus 0.4. So it was perhaps an important tool in order to bring the yield curve down, particularly in the short end. It was also, nobody says that really, but it was a very important tool to drive the euro weaker against the dollar and other currencies. But everyone, also the central bankers, are aware of the distortions that this creates against the financial sector, but also the broader macroeconomy. So I think it's certainly part of the tool set, but we're very much aware of the negative consequences of negative rates. So in the future, if we assume we normalize over the next couple of years, I think in the future going back to negative rates is certainly possible, but people are aware of the negative consequences perhaps more than they were before going negative for the first time.
Iain, do you just assume financial repression dampened real rates out into the future in Europe, not in America, but in Europe? Is it just financial repression reigns?
It is, unfortunately. That's the kind of the world we live in at the moment, where we're seeing this low growth, low inflation environment. I would agree with what Reinhard said. I don't think the central bankers would like to go back into negative rates once they get out of it, but the reality is if they may well have to during the next recession.